Let's dig into the Southwest Airlines balance sheet and see what we can find. So I have the balance sheet here, and if you think back to the income statement that we looked at for Southwest Airlines, you can see we're using the same time periods here. This is a quarterly snapshot. The one difference between an income statement and a balance sheet is the income statement is a summary of what occurred during a specific period. And when we were looking at the income statement, I noted that, pay attention to the period you're looking at because, if you're looking at net income over a year, that's going to be a much different figure than if it was over a quarter. So you needed to just pay attention to the period you're looking at. The balance sheet is different. The balance sheet is a snapshot at a point of time. It's always at the end of the period, and it wouldn't change if that period was a month, a year, a quarter, 5 years, because it's just a snapshot at the end of the period. And the document that's going to reconcile those two. So, for example, you're going to see the bottom line on the income statement is net income. Well, what happens to that net income? Some of it's going to go to cash. How is going to get from the income statement to the balance sheet? And the document that reconciles those two is going to be the cash flow statement. And we're going to look at that in the following videos. So when we look at what's on the balance sheet, in order to determine how it got there, generally, at least in the cash items, the cash flow statement is going to be the place to look, and that's going to come up in just a few minutes. So I wanted to mention that. Well, let's go through here and look at a couple of sections here, and then we're going to use the information that we find to do some analysis. So we're going to start with the current assets section, and let me just get my marker here, the current assets section, and then we're going to go down to current liabilities. So let me just flip down there and show you for this video the two sections we're going to look at. So we just need to understand some of the items in these two sections, and then we'll have enough to do some analysis. So within current assets, well, first let's define what current assets are. Current assets are what are considered liquid assets, so things that the airline can turn into cash within a short period. And the period, let me get my pen here. So the real definition is current assets can be turned into cash within 1 year. So let's look at some of the things. Well, the first thing is cash, so we can turn cash into cash very quickly. Short-term investments, and then things like accounts receivable, things that money that's owed to the company, inventories of parts that could be turned into cash relatively quickly. And this list here is in the order of liquidity. So the most liquid asset a company has is cash. So cash is already cash, so that's the most liquid asset. The second most liquid asset they have is short-term investments. Short-term investments can be things like certificates of deposit, it can be short-term bonds, things that can be readily converted into cash if it was needed. So when we think about the cash balance of a company, certainly you can just look at that first line, and that is the cash balance. But generally, if you were doing analysis, what is the two really liquid assets of the company are really the first two things, because this is so close to cash that we generally think of these two things together. So we're going to use this time period here so we can compare these figures to other airlines. And when we say, what is the cash balance of Southwest, we're going to consider for our purpose that it's, I added these things together before, and those two items are $3.3 billion. So let's say, as we go through our analysis here, that Southwest has $3.3 billion worth of cash and a total of $4.773 billion worth of liquid assets or current assets. The next question we're going to want to answer is, well, is that good? Is that enough money? Is that too much money? It sounds like a lot of money, but without some frame of reference, we don't really know what to make of that number. And there's two things you want to consider when you're evaluating the cash balance of a company. One thing is where the cash came from, and then the other is what they're going to need it for. So, sources of cash, let's rate that just up here. Sources of cash. So, where does cash come from? Well, the best place it can come from is net income, right? So, the company earned money. Net income. The company earned money, and some of that net income was converted into cash and showed up on our balance sheet. The next place it could come from is debt. So the company borrowed money through various means, and they use that debt to increase their cash balance. And depending on what they're going to use that debt for, that could be a very positive thing, or it could be a negative thing. If they're borrowing money to finance the growth of the airline, or to take advantage of some opportunity that came along, that could be a very good sign. But we need to understand that a little bit better. And then the third thing is, I lost my pen, there it is, debt is from selling assets. So in general, these are the three things that you're going to find that drive cash balance. And selling assets, well, you just need to figure out, why that happened. If a company was selling assets they no longer needed and added that to their cash balance, well, that would be a positive thing, I guess. If it was a company in trouble and they were selling assets to pay the bills, well, that would be a pretty negative thing. So the first place you're going to want to look to determine whether that cash balance is, whether that's a good or bad thing, is where that money is coming from. And the place you go to find where that money is coming from is the cash flow statement. So that's why that document is so important, is if you want to evaluate the real cash position of a company, where the money's coming from. It's one thing to look at the balance, but the balance in isolation is much less important than where the money is coming from, how they're generating that cash. So we're going to take a look at that in later videos. Let's now go down to the liability section, because the other thing you want to look at is, so first is where did the money come from, and second is what you're going to need it for. So let's flip down here and see if I can keep this balance on the screen. Let's see, I'm going to go up here. Yeah. So the current assets were 4.73. Let's now go down and look at something called current liabilities. Current liabilities. And the definition of current liabilities is the same thing as current assets. So current liabilities are obligations that need to be satisfied in less than a year. So assets can be turned into cash in less than a year, and liabilities need to be satisfied in less than a year. And you'll find things, and we're going to talk about one thing in particular here, but things like accounts payable. So you owe money to your vendors for services provided, but you haven't paid them yet. Accrued liabilities is things that you've expensed on the income statement, but you haven't paid yet. So it's just like payable. So this is money you owe. I mean, you're at some point you're going to have to satisfy these obligations. And let's skip over to our balance here, and let's see that Southwest has current liabilities of $5.546 billion. And now you can start to put that $4.773 billion into context. Well, $4.7 billion is a lot of money, but when you look at your obligations and you have $5.5 billion worth of obligations, well, the 4.7 isn't looking quite as big anymore. But let's go, I want to talk about one line item in particular here, which is unique to the airline industry, and this is this air traffic liability. And it's important to consider when you're doing analysis, because it's a really big number, $2.981 billion. So almost $3 billion of the $5.5 billion comes from this one line, air traffic liability. And what air traffic liability is, the amount of money that the airline has collected for tickets they've sold, but the flights haven't departed yet. So they're collecting this money, but they haven't delivered the service, and they can't put it on the income statement as income until they deliver the service. They're at this point they're just holding their customers' money. And should the need arise, if the, in the extreme example, if the airline went out of business tomorrow, they owe that money back to their customers. They didn't deliver the service. So until they deliver the service, they have this liability. Well, for an airline, you're always going to see a big number here because customers buy their tickets in advance. You buy your ticket, weeks, months in advance, and the airline collects that money and they book it as a liability. They certainly have every intention of satisfying, of delivering the service. So unlike these two things where you actually are going to, Southwest is going to pay off these liabilities, their vendors or whatever. This is a liability that has to do with money they've received, but they haven't delivered the service yet. So when we put these two numbers in context, we're going to want to consider that. And in the next video, we're going to have enough information and we're going to do some analysis on these numbers. The other time that this air traffic liability, you also often see this abbreviated as ATL, the ATL. This becomes extremely important when airlines become financially vulnerable, when they're in dire straits. So this probably isn't too relevant to Southwest, but there's certainly been airlines in the last couple of decades that have gotten in real cash trouble, and they were looking at a big liability here. So a couple of things could happen, right? So let's say the airline went out of business and they didn't have enough money to pay off their ATL. Well, you might think, well, the customers are just out of luck. But in reality, most customers purchase their tickets with credit cards. And the credit card companies would be on the hook if the airline didn't have enough cash to satisfy that liability. So when an airline is facing bankruptcy or getting in financial trouble, the credit card companies will put a lot of pressure on the airline to guarantee that they can satisfy this liability, and that pressure alone could push them into bankruptcy. We're going to talk about that. We're going to do a couple of videos just on what drives an airline into bankruptcy, and we're going to see, with probably not just airlines, but that's what I'm familiar with. It's not profitability. So you don't. The biggest concern about an airline slipping into bankruptcy isn't how profitable they are. It's how much cash they're generating, because cash is the lifeblood of a company. If you don't have enough cash flow, it's these kind of things that will really get the airline into trouble. So in the next video, we are going to use these numbers and we're going to calculate a couple of metrics and compare them to other airlines and see what we can make of Southwest's cash balance.